got a big picture discussion here with our Charles Schwab team heading into the bell. Looks like it's going to be a bit of a fight. Bulls losing it a tad. Nate Peterson joins us, Director of Derivatives Analysis, and Cooper Howard's back from the bonds side, Director and Fixed Income Strategist at the Schwab Center for Financial Research. So firstly, I think bonds kind of started the problems here, Cooper, as folks saw 50 bips, bought a bunch of bonds, and then market sold them even harder back. What did you make of that swing?
Yeah, I think that was a pretty interesting swing, Oliver. I mean, obviously, when we first saw the news that it was going to be 50 basis points, you saw yields drop a little bit. I think that was to be expected because coming into this, we knew that it wasn't a unanimous or it wasn't 100% of a decision. There was still a little bit of a debate of were we going to go 25 or were we going to go 50? So I think that initial move wasn't too big of a surprise. Now, the move from there, I think that's more about positioning. So I don't read too much into it. I think a lot of things could be looked at as far as the longer term move on the yield curve. I think what that's more notable is probably where they moved the terminal rate. I think the terminal rate ticked up just about 0.1%. So overall, it appears that the Fed's pretty confident that they can achieve that soft landing narrative. So I think that's probably why you saw the 10-year or longer term rates trading on those better growth prospects.
That's a big part of it. And we talked a little bit about that yesterday, that kind of reflexive nature of bonds, where you do a big cut here. You know, that's the point of duration, right? You give yourself a better chance down the road. The 30 years are going kind of wild right now relative to the twos. Like, is it possible this is a stimulative event, Cooper? Or, I mean, should we describe it that way?
You know, I think that was also one of the interesting narratives coming into this is that if they go by 50 basis points, does that send a signal to the market that is the Fed knows something that we don't know, and it's actually a negative? I thought during the press conference, Chairman Powell did a very good job of kind of threading the needle and saying the economy is in a relatively okay point right now, and that's why we're going big up front. So trying to get dismiss that narrative of they're going 50 because they know something that we don't know.
Okay, let's talk some stocks here because that's a good way to think about it, is 50 for good reasons or bad reasons. And I think the stock market kind of renders the verdict on that to some degree, Nate, where you could interpret this as going, all right, well, I guess maybe, you know, we really do have an economic issue. However, at the same time, stocks have premiums and valuations, Nate. So could we just say that maybe stocks are too expensive?
Yeah, and I think the technicals are kind of, suggesting that when you look at the S&P 500, it's gone up to that level you were just referring to, that roughly 5650-ish, around that area. We were hanging out there and unable to make a new high back in August. Same thing yesterday, same thing today. And so from like a near-term trading perspective, then, yeah, so what it's conveying is, hey, you got a forward PE of 21. We've kind of been telegraphing this narrative around interest rates in the Fed, and we all know that's kind of baked in. So what to do from here? And it's likely going to be underneath the covers. There's going to be some rotation and perhaps some positioning. But the price action today just suggests markets were largely positioned for this. I don't think that the growth scare narrative is that great because, really a lot of this started back with Bill Dudley and his comments, those recessionary indicators that triggered, and the weakness in the unemployment rate and the non-farm payrolls that have been coming down. But since then, it hasn't increasingly really gotten worse, I don't believe. I mean, the unemployment rate came back to 4.2 from 4.3. And so the Fed is doing, they're reacting to their dual mandate. They're noting the softness in the labor market. And here their positioning is such, and I don't think 50 is that big of a deal when you look at the disparity between the 2-year and where they resided prior to today.
Yeah, exactly, right? As you know,
yeah.
You're just moving and you're got to get down there somehow. Why not just get down there? If it's a pretty far ways away, take a big step. Nate, as far as stocks go, I mean, I would really be frustrated if this is another week we end at like the 56 handle in the S&Ps, because maybe that's the pain trade, though, is it just go nowhere on all of this.
Right, and let's keep in mind around Fed days like this, regardless of where we close today, you could get the opposite reaction, another digestion, so to speak, in terms of what this means for the market. but we are up against that resistance. So, if you can break out to to above resistance to fresh all-time highs, then this kind of gives a permission slip that, okay, maybe that is the narrative and we can run with that for a little bit. And now we're breaking out into space. So technically, we don't have any resistance that we're up against. Conversely, though, if you come in tomorrow and we're also red on the futures, then from a risk reward perspective, there's asymmetry. We have to go down to basically 5,400 on the S&P 500 before you find support, but we might be lodged up against resistance. And then lastly, we've got, bearish seasonality with September, the last 2 weeks. Does this kind of kick in, or, do we have the bulls have the muster to kind of take us to fresh all-time highs? We'll know tomorrow morning.
Okay, good stuff. We got about 2 minutes until the bell. Thank you, gentlemen.